All right, Bitcoin has been waffling around the last couple of months, even with that halving that was supposed to be a bullish indicator for Bitcoin. This is where the Bitcoin reward for mining Bitcoin is cut in half. Fred Thiel, CEO of Marathon Digital Holdings, joins us now, a Bitcoin miner. Fred, thanks so much for joining us. So why didn't we see the explosion to the upside, Fred?
Well, I think what ended up happening is the spot ETFs really sucked a lot of demand out of the market early on. Traditionally, you'd see about 6 months after the halving, the run up in price. And what we've seen is essentially the ETFs pulled that forward. But what's interesting to note is, you have almost 1,000 13F filings for institutional investors who invested in the ETFs, about $11 billion worth of capital. Granted, $50 billion of capital was retail, $11 billion was institutional. That is a huge success compared to the gold ETFs that in their first quarter only had about 95 institutional investors. So overall, it's been a huge success, but that pulled demand forward ahead of the halving. And I think now we've had some choppiness, but now that I think also there's a little bit of clarity on the macro, we're starting to see Bitcoin, gold, and equities moving in unison upwards quite strongly. So still optimistic about where Bitcoin's going to end the year and still very positive about its trajectory.
Well, with the advent of those ETFs really flooding the market, and to your point about uptake, I think it raises the question about these miners like yourself. Before the ETFs, there were very few ways to play in your traditional investment portfolios, cryptocurrencies, in ways that were tax advantaged. But now that you can, what do you explain to people as the edge on holding a Bitcoin miner versus an ETF?
Well, so I think there are lots of different ways to invest in Bitcoin, just like any other asset class. You can hold an individual stock, or you can invest in an index, you can invest in a fund. The benefit that you have in investing directly in a miner is that you get the beta of the potential profit or margin benefit, because a miner is mining Bitcoin at lower cost than what the spot price is. And so you get beta because of that. It's the same reason you look at something like MicroStrategy. MicroStrategy is not a miner. They're just borrowing money, raising capital through the equity markets and buying Bitcoin and holding it. And yet they perform with a beta to spot Bitcoin. So it's all about getting this additional upside potential, if you would, and leverage. The other thing, you now have the CME that is looking to enter the market with spot Bitcoin. Why are they interested? Well, because if people are trading on the CME, they get the benefit of having the ability to leverage spot Bitcoin and go long or short using leverage, which creates potentially some more volatility down the road. But that is going to take a fair amount of institutional dollar interest away from ETFs potentially, because it gives them a lot more leverage and an ability to really goose their returns, if you would. But look at gold. Warren Buffett invests in gold miners instead of spot gold. I think it's very similar with Bitcoin miners and Bitcoin.
Mining, let's talk about your company. As people talk about gold mining companies, you mentioned the cost relative to the price. What are your costs per BTC compared to what you can get in the market for Bitcoin?
So a good way to look at it is you can think of the cost to mine Bitcoin for most miners across the industry at somewhere between roughly $45,000 a Bitcoin upwards to the low 50s. So with Bitcoin at $67,000 more or less today, still quite profitable for the miners to be mining Bitcoin. The key here is all about what price you have for your energy, and are you doing energy arbitrage? What are you doing to lower your cost to mine Bitcoin? And is the company a diversified company? In our case, we're diversifying into energy harvesting, technology product sales, tied to Bitcoin mining and digital infrastructure. And that helps us lower our overall cost to mine because part of our SG&A is absorbed by the revenue streams and profits from those other businesses.
What's energy harvesting?
Energy harvesting is essentially taking wasted or stranded energy. It could be methane from landfills, it could be flare gas from oil fields, it could be biomass from things like ethanol or methanol production. You take that material, you turn it into energy, and then you use that energy to mine Bitcoin. By mining Bitcoin, you're generating heat, and when you generate heat, you can feed that back into an industrial process. So for example, an ethanol manufacturer has to preheat the biomass before they make the ethanol. It's a way to save them money. They pay us for that heated for the heat source. They pay us to process the waste material they have. That effectively negates our energy cost. And then we're mining Bitcoin for free. So it's a different way of mining Bitcoin, but over time, what will happen is it'll dramatically lower our cost to mine Bitcoin compared to traditional utility scale miners.
Do you have a number of how much that could reduce costs?
Well, in some cases, for example, if you look at landfill gas uses, it can drop your cost to mine Bitcoin by almost 40–50%. In the case of a full cycle where you're taking biomass, converting it to energy, and then selling heat back, it could potentially bring your energy cost to zero to mine Bitcoin.